Is the stock market overvalued? Are we going to see a stock market crash anytime soon? My name is Mo, and in this video, we'll be trying to answer these questions by looking into a number of key financial metrics. We'll take a close look into the S&P 500 historical information and review their price to earnings ratio, Shiller price to earnings ratio, and price to sales ratio in order to assess where the stock market may be headed. Let's get into it. Let us start by reviewing the price to earnings ratio. The PE ratio helps you decide whether a single company is undervalued or overvalued by comparing its stock price to its earnings per share, EPS. High price to earnings ratios generally signify a company is overvalued, whereas low ones indicate it may be a good value buy with the potential for high future returns. Looking at the price to earnings ratio for the S&P 500, you'd notice a multiple of 20.03. which is higher than the historical average of 15.97. The maximum ratio in the past 150 years was back in May of 2019, where this multiple was at 123.73. And the lowest goes back to December of 1917, where it was at only 5.31. One challenge with a standard price to earnings ratio is that they can be unduly influenced by near-term changes in a company's earnings performance that have little to do with its fundamentals and more to do with big market-moving economic events. These can include things like a market correction, a recession, or big changes in a company's industry. That's why Yale University professor Robert Shiller proposed looking at inflation-adjusted 10-year earnings data to minimize the impact of short-term impacts. This way, investors could better determine whether an index was truly over or undervalued. While it can be used to analyze individual stocks, the Shiller price to earnings ratio is generally applied to an entire stock market index, most often the S&P 500. When used in this fashion, the Shiller price to earnings ratio provides an accurate measure of the value of an entire stock market index that smoothes the short-term earnings volatility experienced by its constituent companies. The Shiller price to earnings ratio helps investors understand whether stocks are overvalued or undervalued while also correcting for short-term volatility. This analytical tool is most commonly used to evaluate the overall US stock market. It is also known as the cyclically adjusted price to earnings ratio, CAPE, or the Shiller price to earnings ratio 10 due to the 10-year data it uses. The formula for the Shiller price to earnings ratio is simple: current price divided by average inflation adjusted 10-year earnings per share. To do that, you'll need to find an index's earnings per share for each of the past 10 years, adjust each for inflation to bring it into the current dollars, and find their average. You'll then divide the index current price by this average. The Shiller price to earnings ratio gives investors a read on whether the stock market, as represented by the S&P 500, is overvalued or undervalued. The higher the Shiller price to earnings ratio, the more overvalued the market. For context, over more than 100 years, the average and median Shiller price to earnings ratio has been around 15 or 16, and spiking up significantly higher, often before stock market crashes. But the all-time high in the Shiller price to earnings ratio was December of 1999, when the figure reached 44.19. This high Shiller price to earnings ratio coincided with a dot-com driven rally in tech stocks of the late 1990s. Based in part of that record high ratio, Shiller correctly predicted that the dot-com frenzy would turn out to be a bubble. Currently, the Shiller price to earnings ratio is at 31.21. While it has come down from its high 30s mark reported a couple of months ago, it is still way higher than the historical average of about 17 for the S&P 500. Lastly, looking at the price to sales ratio for the S&P 500, you notice a multiple of 2.53, which is much higher than the average of 1.66. The maximum ratio in the past 20 years was back in December of 2021, where this multiple was at 3.04. And the lowest goes back to March of 2009, where it was at only 0.8. Now, given the current read of the financial metrics that we reviewed, it does appear that stock market is still quite hot and somewhat of an overvalued at this time. So I wouldn't be surprised if we continue to see some of that continued pressure on the stock market and potentially some more red days ahead of us. And if that holds true, that is just in alignment with what we've seen so far in the year of 2022, whereby the year started in negative territory overall, and all the major indexes so far in the year are in that red zone territory. I would love to hear from you. How are you navigating through these difficult, volatile stock market days? Are you adding to your existing positions or perhaps staying on the sideline waiting for the right time when the stock market has hit the bottom? Let me know in the comment section down below. If you enjoyed this video and gained something of value from it, please give this video a thumbs up and share it with someone else who might benefit from it. And of course, subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in the stock market, including dividend stock, growth stocks, and penny stocks. We also talk about ways to reach financial freedom. Thank you, and I hope to see you next time.